Today, we're looking at how the Indian Hotels Company Limited has reported its 16th consecutive quarter of record financial performance. This chart tracks their growth over the past 4 years. We see double-digit growth across all major metrics, culminating in fiscal year 26 with 9,971 crores in consolidated revenue and profit after tax crossing the 2,000 crore mark. In the hospitality sector, long streaks of unbroken record profits are rare. The industry carries heavy fixed costs and relies on discretionary spending. This usually makes it highly sensitive to macroeconomic cycles. That sensitivity was tested in fiscal 26. Geopolitical shocks in West Asia generated an estimated 100 crore drag on revenue. Yet these financial trend lines push right through those disruptions without a dip. The localized softness hit international markets directly, depressing outbound travel to properties in London, Dubai, and the Maldives. Taking a direct 9-figure hit to the top line usually compresses corporate margins. Here, the enterprise absorbed the shock and maintained an overall EBITDA margin of 35%. Earning those margins through a global demand shock is the result of a structural rewiring of the corporate business model. Management executed this change by adjusting 3 specific operational levers: resilience, scale, and future readiness. The foundation is a diversified brandscape. Operating across distinct brands, the company captures a wide spectrum of travel occasions and price points. This architecture isolates risk, blending volatile, high-revenue luxury assets with the steady cash flows of mid-scale managed properties. When international transit hubs saw revenue drags, the domestic portfolio compensated. Key Indian leisure markets like Goa saw RevPAR growth exceeding 25%. By engineering an interconnected ecosystem of brands and contract types, the company operates an internal macro hedge. Isolated regional shocks are absorbed by other segments, protecting aggregate enterprise profitability. The first operational lever driving this structure is scale, achieved through a transition away from heavy balance sheet real estate toward capital-light management contracts. This conceptual balance sheet scale illustrates the current operating reality. 68% of the portfolio is now running under managed or asset-light formats. The forward-looking pipeline accelerates this shift, with over 31,000 keys currently under development. The critical metric defining that pipeline is capital deployment. 93% of those upcoming rooms require minimal to zero capital expenditure from the company. This strategy shifts the weight of the profit and loss statement. Managing properties rather than building them lowers the fixed costs associated with physical ownership. Decoupling top-line management fee growth from heavy capital expenditure drives up return on invested capital. Scaling high-margin management fee revenue creates a risk and return profile closer to a service provider than a real estate developer. The impact of the future readiness pillar is concentrated in the new businesses vertical. This segment, driven by brands like Ginger, Cumin, and Ama, delivered 25% year-over-year growth and maintains a 31% compound annual growth rate over the last 4 years. The proof of concept for this capital-light, mid-scale model is the flagship Ginger Hotel at the Mumbai airport. This specific asset recently generated over 100 crores in revenue for the first time. This breakdown shows the unit economics of that revenue. Once you slice away the lean operating costs, the asset yields an industry-leading 56% EBITDA margin. Mid-scale platforms operate with drastically leaner cost structures and lower staffing ratios than luxury assets, allowing more gross revenue to flow directly to the bottom line. Management's strategic goal is to replicate these exact unit economics by scaling the Ginger brand to 250 total operating and pipeline hotels by fiscal 27. Rapidly injecting hundreds of 50% plus margin units into the broader portfolio mathematically forces the aggregate enterprise margin upward. The final operational lever is resilience, which deals directly with legacy luxury assets. The company is still deploying between 1,000 and 1,200 crores in annual capital expenditure into its owned portfolio. This spend is highly targeted. It is designed to renovate inventory, reinforce pricing power, and defend the luxury premium of flagship properties. Taj Lands End serves as a case study for how yield management works in a high-barrier market. The property operates consistently at an occupancy rate above 90%. Standard industry practice often involves trading average daily rate for higher occupancy. Management pushes both rate and occupancy higher simultaneously. In the Indian market, high room occupancy has a compounding effect. A full hotel drives high-volume, profitable food and beverage revenue inside the property. Maximizing absolute yield on these legacy assets creates an engine of massive absolute cash flow. This cash funds the asset-light expansion of the newer brands without requiring external debt. Combining these mechanics allows us to analyze the predictability of management's forward-looking guidance. For fiscal year 27, the company projects sustained total revenue growth between 12 and 14%. This waterfall chart shows how that target is constructed. The first foundational block requires 7 to 9% organic RevPAR growth derived from the existing portfolio. Hitting that baseline relies on domestic demand colliding with strictly limited incremental room supply across key Indian markets. The second component is the remaining 4 to 5%, which is engineered through not like-for-like growth. The drivers of this additional revenue are the execution of over 60 new hotel openings and the continued scaling of recent acquisitions, like the wellness brand at Montan. The 12 to 14% projection is generated by combining organic pricing power with asset-light pipeline execution. The entire operational structure of the company functions like a barbell. One end of the barbell holds heavily invested, high-occupancy, legacy luxury properties. This end generates massive absolute cash flows and defends the brand's premium market position. The opposite end holds the rapidly scaling, asset-light, mid-market portfolio. This end drives margin expansion and maximizes return on invested capital. By balancing heavy cash flow engines with lightweight scaling platforms, the enterprise has insulated itself against market shocks while driving a structural shift in hospitality unit economics.